Hope everybody's doing well. We've got a guest with us today, Jamie Hopkins, and Jamie is an incredible resource in the Carson Group world. We've talked last week. We had Scott Kuby on. We were talking some investment topics. This week, we're going to kind of focus in on one little idea that we often discuss with clients around planning in kind of different ways to look at your portfolio construction. And the thing that we'll be getting into is this idea of bucketing. We've talked to some of you about that before, and Jamie, I know this is something you've written about and you've talked about, but I want to throw an image up real quickly. Hold on, I'm multitasking here. So if we were in my conference room, I would very likely draw something like this on the board if we were having this discussion. And Jamie, you know, we use this I know different advisors will use this concept in different ways. I've been in the business quite a while, and I remember this concept going back at least 20 years. It's one of those ideas. It's very basic, but it just seems to always be helpful to take the complex idea of investing and kind of simplify it, as we kind of think about different ways you can position your money in three different buckets of money here. One of the ways that this is often positioned is thinking of it in terms of what money is in bucket one that I want to have access to now. And then bucket two would be money that I would need access to soon. And then the more volatile stuff, the more growth-oriented stuff would be later. Sometimes we think of that in terms of the attributes. Some people talk about bucket one as the liquid bucket, the bucket that I can turn into cash almost instantly, or maybe it's already in cash. And the second bucket might be more of a moderate blended allocation, or maybe a hedged equity type strategy. And then the third bucket would just be pure growth. And then the other way I've seen this described is bucket one would be money that you'd want access to within the next 1 to 3 years. The middle bucket might be 4 to 7 years, and the third bucket might be 8 to 10 years or more. So there's a lot of different ways you can view this. And when I was thinking about this, Jamie, in the volatility we've been having, it doesn't happen to this extreme this often, but when it does happen, it's always concerning. And if you've got clients who are already taking income off of their investments, then sometimes we talk about bucket one as maybe an alternative place where you can turn on income temporarily from there. So you're not taking money out of your more bucket three type or bucket two type asset allocated assets. Give them time for the market to recover. So there's a lot of different ways we can discuss this. And when I was thinking about this, I thought, well, this is pretty relevant discussion right now. We've gotten a lot of calls from clients who said, you know, it sounds like I can turn my RMDs off now. Should I be doing that? But I still need income. Where should I pull it from in the meantime? So we've been having those kind of discussions. And I thought, well, let's just get back to the basics and talk about the bucketing strategy. And for those of you who aren't familiar with Jamie, his position with the Carson Group is Director of Retirement Research. He's also the Managing Director at Carson Group Coaching. But he's also a regular author and has articles posted on Forbes. In fact, one of the things we'll be hitting on today is kind of how could you look at potentially your home equity as a sense of liquidity. There's a way of looking at that, believe it or not. We don't think of home equity as liquid, and it's not usually, but there are some planning strategies you can use to where you can potentially see that as a bucket one strategy. Jamie just wrote an article about that here a couple of weeks ago. In fact, let me just, I think I've got that article handy. Let me pull that up and let folks see that, Jamie, if we can find it.
Yeah, and if you want, I can.
There it is. Yeah, so there's your smiling face on your Forbes page, and I think it was this article here.
Yeah.
On April 21st, you were writing about home equity and your retirement plan with the bucketing approach, and I thought, well, how ironic. That's one of the things we'll be talking about today. So with all of that being said, Jamie, I just appreciate you taking some time to be with us, and just kind of before we get started talking about some specific ideas and strategies that might fit into that bucket one, just kind of, tell us a little bit about yourself and kind of your passion in this industry, and also how you tend to come down viewing the bucketing strategy from your perspective.
Absolutely. We'll try to keep that succinct. So I appreciate everyone, having us on and showing up here today. Hopefully everyone's staying safe and healthy right now. I'm actually a little bit opposite of the Thor picture. I think I've lost 8.5 pounds since I've been back. So I'm usually on the road traveling, and that means a lot more drinking and eating out. And so that I haven't had much to drink in the last, month and a half. So I'm losing some weight, which is nice for me. But retirement planning is really what I spend my time on. And I've been kind of doing retirement plans, whether it's been, qualified plans at the employer side, the federal level, down to teaching advisors on this, and now being part of Carson Group and helping our retirement side. What I tell people is it's what I go to bed thinking about, wake up in the middle of the night thinking about, get up in the morning and start working on again. And so you can actually just see up here, right? I've got, 4 articles in Forbes, less than a month apart. They're all on retirement planning. And it's a really important part of my life. And really the reason comes back to my family. And what I tell this story, my dad passed away when I was young. I was in construction, and my mom raised the kids and ran the company, didn't go to college. And, it's really just been kind of core to me to help move the needle there as it relates to just getting more people, more Americans comfortable, like my mom, for retirement, that didn't have a pension plan, didn't have a 401k, and, has Social Security, Medicare, and their house. And so that's also kind of why I realized the house was so important. She is, I guess, 68 now, still working, almost has her mortgage paid off, right? And, that's probably, by far her largest asset, and Social Security will be her largest income source. And so kind of recognizing how important those systems are, and housing as part of a retirement income plan, it just is core to me. So I spend more time thinking about that than some others that might have grown up in kind of more of a traditional, investment world, which is why you didn't get a lot of thoughts around the home, because they weren't working with the home, right? The clients that they were working with weren't necessarily drawing from their home. They had investable assets. But we actually had Robert Murden, who's a Nobel Prize winner, has come out the last 2 years or so and really started incorporating home equity into his research. That's probably the highest level person out there now that started to think about this differently. And so that's encouraging that there is a shift occurring.
Yeah. Yeah, it is, for years, one of the things you'll get into here in a bit is kind of talking about HELOCs or home equity lines of credit, but reverse mortgages is another thing we're going to touch on today. And even today, Jamie, every time we in the education process with our clients talk to them about that, there's kind of this instinctive negative reaction to it. And I've always been agnostic on them. If they're a bad deal and they're heavy on fees and everything, we're not going to recommend a client does them. It's all about having arrows in the quiver, as we like to say. If it solves a problem, then let's talk about it and let's look and see, does this make sense for the unique circumstances of that client? But I know that you've really got a lot of experience talking and teaching about that particular idea. So that was another reason I thought of you when I thought we talked about this bucket one strategy. Yeah. When you interact with other advisors around this bucketing concept, how do you tend to organize that in your mind? Is it the kind of the now, soon, later, or is it more the years, or how do you tend to look at it?
So, I mean, when I talk to advisors, it's a little bit different than when I'm, talking to, a client situation, but we tend to use that the now, soon, later type of language works very well. Yeah. The reality is that bucketing kind of came about. I mean, you could probably draw back to the late 1980s, early 1990s. There were a couple advisors out there, a researcher and advisor out of Texas Tech, Harold Levinsky, and they were just doing research around, the sequence of returns risk. And what that really means is market volatility, right? The last month is a huge risk. You sell one day, it's terrible. The next day, it's good. Who knows? And there's risk associated with that for retirement, more so really than any other time in your life. And so what tends to deplete retirement funds is the fact that you have to sell your investments to provide your income that year during down market years. Mm-hmm. And so there was this idea, well, let's not do that, right? Like the answer is really simple. If that's a problem, let's just not do it, right? Let's do something else. And the first iteration of this was really just cash. You'd have 2 years of cash, and you'd have your other assets, and you
Right.
live for 2 years, and then you'd replenish. And then I'd say, that probably existed as a strategy for a good 15 years. Then kind of what started to happen was we analyzed that. And it's, leaving 2 years of cash on the sideline for 30 years actually brings down the total return of everything you can invest in a good deal. Why? Well, because I've got 2 years of cash, which is probably a lot of money. If you're spending 80 grand a year, $160,000, that's earning essentially zero. Not really keeping pace with inflation, even if you have some type of payment from your bank or a money market account, but really kind of losing true spending value. And that drags down the total portfolio. So then the thought process became, well, maybe we need to get a little bit more, thoughtful here and look for assets that are not market correlated, meaning that we can still take off sequence risk, but still don't have to sell during the down market years. And that's where we then started using more bonds and CD ladders. There's certain types of annuities out there that make sense in it, not all of them, but certain types. Lines of credit had been used for this, maybe not strategically, but people always did that, right? You set up a line of credit on your house in case you need the money. Well, in retirement, when is the in case you need the money years? It's really when, the stock market plummets, or, if a tree falls and there's a hole in your roof, it's a similar thing, right? There's a different spending need. And that's been expanded out now to include things like reverse mortgage lines of credit, and, cash value life insurance. And it's not necessarily that you are going to go into retirement and go buy a new life insurance policy for this, but lots of people get to retirement with a cash value life insurance policy. So then should we use that strategically as part of our income plan? And the answer for most of these is yes, we should be looking at it holistically. And most of the things I just covered fit very well into that bucket one. As when the market's down, we pull from them. When the market's good, we pull from the market. And sometimes people hear that and think that's market timing. It has nothing to do with trying to buy or sell in the market. It's just an acknowledgement that, hey, look, if we have a time period like the last month, that the market is more volatile. That it's down. I don't know when to get in or out, but I know that right now is not the time to be making that decision. Right now is the time to be sitting if I can. And so can I get my income from elsewhere during this time?
Yeah, no, that's great. And there are a lot of different ways you can look at it. That's why I was curious what your perspective was on it. But, I remember thinking years ago, back in the early CFP days, talking about 6 months of living expenses and emergency fund. And I always thought, that's a lot of money, even that, just to have sitting around in cash. But like you said, when you go to having a year to 2 years of cash, we just always felt like, I understand the need for the liquidity because you got to pass the pillow test. You got to be able to sleep at night, right? Yeah. But maybe we don't have to have that much liquidity sitting in an unproductive asset. So maybe you have a combined strategy where you have maybe 6 months of cash, and then the other 1.5 years you have something you can turn into cash quickly, like some of these other strategies. So that's kind of a context. And also, just so you'll know, Jamie, we've started doing these Wise Counsel Live sessions each week, as we got in this shelter in place environment. We thought, what? We want to do something for our clients only. And we only have clients. We tell them, look, if you really have somebody you want to invite, that's fine. But really, these discussions are just for us to give once a week our clients a chance to stop by and just kind of hear some of the conversations we have in the office all the time. Last week, we had Scott Kuby on and we talked about investing. Next week, Zach and I are going to dig into this whole thing about oil and kind of what that might mean. And so this week we've got you on. So again, thank you. But let's get into this a little bit. We kind of organized some talking points around different ideas. It could be a lot longer, but I at least wanted to hit on this idea of home equity as a liquidity source. I wanted to hit on these two retirement provisions in the CARES Act. You've been all over it from day one. And then I also want to hit on an often forgotten asset class. And you've already mentioned it briefly, but let's get into this a little bit. Talk to us about how do I, as an investor and my overall game plan, how do I look at let's say I've got my home paid off, right? I'm debt free, and that's important to me. And my plan is all been great, but I don't want to keep 2 years worth of cash sitting around. How do I look at my home equity as a potential liquidity source for bucket one?
Yeah, let me run through. You've got 3 points on here, and I'll just run through them and give a little, pro con of each.
Mm-hmm.
So you got number one with cash out refinance, right? Literally just finished up a refinance of my mortgage on Friday. I did not cash out anything. What is the difference from just a traditional refinance versus cash out? The reason that I did a refinance is because I bought this house a year and a half ago. Literally, interest rates have come down over 1% on that for me. Some people's might be different, but the closing costs and the difference in the rate over 30, I mean, the break even's less than a year right now. So there's people that have bought houses. I mean, that's pretty atypical of the world, right? Typically, you're thinking 5-year break even on a lot of that. When refinancing right now, for a lot of people, it's 1 year. So if you're just thinking about managing cost over a long term, reducing monthly payments, a refinance right now could do that because rates are so low. The other part is you could refinance or take on a mortgage, right? Those are then kind of similar things. If you're wanting to pull money, essentially, quote unquote, out of your house, but really you're borrowing from the bank and using your house as the security for the loan. But today, where rates are, that's a really low cost to borrow. For whatever it's worth, right? That's a very low cost to borrow. It's still a cost, and there's some closing costs associated with that. So those are some options on the traditional mortgage side. I will mention then HELOC, home equity line of credit. Home equity line of credit, most people here have probably heard about that, probably know somebody who's used one at some point. And that's your standby. There's not a whole lot of cost, honestly, to setting those up. They're probably the cheapest from a closing perspective. The challenge with home equity lines of credit, though, is that they're not as secure in the sense that, like, people set them up with this notion that, hey, it's going to be there. So you had a lot of people that thought, hey, I'm going to have this sitting here. If I lose my job, if the market goes down, I'll pull from my line of credit. We actually just saw last week Chase and I think 2 or 3 other banks announced that they're not taking new line of credit application. Now, they haven't froze the current ones yet, but that's the next step, right? The next step is, if this continues and banks get a little pushed come the fall, they will probably freeze a lot of those lines of credit. So it's there. Unfortunately, I think now watching 2 different market cycles, being the 08 to 2010, and then right now with banks freezing the applications again, I think you have to, as an advisor, an individual, say, yes, I can use it for like a me emergency. I can't think about it in my mind as a market offset, because the bad 2 markets now, both times the banks have reacted by saying, hey, these products are basically off the table. So that challenges the line of credit a little bit as a coordinated strategy and a bucket approach. Not entirely off the table. It's still very useful. Like, as I said, tree falls on your house, puts a hole through, you've got a couple $1,000 deductible, you don't have an extra couple $1,000 that month. Well, there you go. Line of credit, great way to pay for that. Third one here, reverse mortgages. As you mentioned before, and I've done a lot of actually consumer research, literacy, just how people feel about these. Reality is, like, there's a negative perception of reverse mortgages out there. A lot of that is warranted, and half of it is also like very poor, what I would just say is, news coverage, which I think probably everyone in the country now understands that, like, news coverage, regardless of which place you're going to, isn't always perfect. And the reality is, news organizations have struggled to cover reverse mortgages. So you've probably all seen something on TV where there's this old lady being like walked out of her house, and there's a news thing saying, hey, Mrs. Smith lived there for 60 years and she lost her house because she had a reverse mortgage. It's probably not accurate. It's parts of it are accurate. She lost her house. She was old. She lived there a long time, and she had a reverse mortgage. Now, those things were not the causes of each other, right? The reality is, most of those individuals lose their house because they don't pay property taxes. If you don't pay your property taxes, you can lose your stuff. Doesn't matter if you have, your Wesley Snipes and he went, very famous person who got in trouble for not paying taxes, right? If you don't pay your taxes, government will come after your stuff. That tends to be the case with some people in the reverse mortgage, where this kind of negative mindset was created because they were really using it as what we would call a line of last resort. They had exhausted every other option they had. And then their home equity was actually in bucket 3. It was the last thing they had. Then that was exhausted. They couldn't meet any payments. They lose their house. Yeah. And so what's kind of happened is there's a regulatory body for our profession called FINRA. And FINRA actually used to have language going back to 2010 or 11 that said reverse mortgages should be viewed as a line of last resort. Reverse mortgages actually should be used early in retirement, not at the end. And conceptually, it starts making sense when you lay something out as a bucket. Because if you think about your home equity, it tends to grow pretty slowly and is otherwise fairly illiquid. It's not actually a great third bucket option. The third bucket should be your growth assets that are going to perform very well over long periods of time. So where should you use the asset that only keeps pace with inflation? Well, what does that sound a lot like? It sounds a lot like a cash account up front, but it's illiquid. So most of the research is now supported, not, really kind of using that as this non-market correlated asset, using reverse mortgage lines of credit, refinance, HELOCs to offset some of the risk early so you don't have to spend your growth assets when the market's down.
Yeah, that's a great point. For years, we all have talked to clients, advisors I know, and there's this assumption by so many people, Jamie, that the only thing they can really trust is real estate. And my theory over the years has been that, number one, they understand it, right? And we tend to trust what we understand. Number two, real estate by its nature doesn't allow us to do what is most people's biggest mistake, and that's bounce in and out, right? Reacting emotionally. You're kind of stuck with it. And so you own it for years. I mean, heck, you're living in it for most people. And so guess what? It goes up in value over time, shocking. But it's the same thing about other investment assets. They just tend to grow faster. So that's interesting, the way you put that. I like that. So we could spend a whole session just talking about reverse mortgages and the nuances of that. But basically, a reverse mortgage could be looked at as either an income option, right, to turn on some income as an alternative, or it could be looked at as a getting a chunk of money out. Let's hit these other two topics. I know the retirement plans. They have some more liquidity provisions available in this CARES Act that came out, and you've written a lot about this. And I just noted a couple that we'd touch on. The increased loan provisions for people who still have active 401k type plans or 403b plans that allow plan loans, and then the other one is the hardship withdrawal. They've given us some options there. So hit on those real quick for somebody who needs short-term liquidity from that as a source.
Yeah, absolutely. And actually, it's funny, you have up on the screen there 5 ways the CARES Act impacts retirement planning. So it's in there too.
That was back on April 10th, right? Are you releasing an article every week on Forbes? Is that your writing schedule with them?
Yeah, I write about 2 articles a week each, for the whole year. But yeah, I kind of a week or 2 a month with Forbes, but I publish other places too. 2 quick things there. Probably the easier one, honestly, to kind of cover is there's something that's called the coronavirus-related distribution that was just created as part of the CARES Act. What it allows you to do is pull up to $100,000 out of a 401k or IRA, and essentially not have it, if you're under age 59 and a half, penalty tax, but it's available for anyone. So you can pull that money out. You can actually spread the taxes of it over the next 3 years, so 20, 21, 22. So if you took 90 grand out, you could spread 30 over each year. And then you actually have the ability to pay it back within that 3-year time horizon and not have it treated as taxable income at all. So it really is a way to access your retirement accounts, right? Spread out the tax burden and pay it back if you want. The qualifications for it, there's really 1 or 2. It's either you, your spouse, or dependent was diagnosed with the coronavirus. And then number 2, you had adverse financial consequences due to being furloughed, laid off, quarantined. And then there's this other factors is set by the government, but they haven't set any other factors yet.
Yeah. So if somebody had a drop in income in 2020, they might want to pull it out and just go ahead and report it as taxable income all this year. But if their income hasn't been that much affected, then they might want to spread it out and then pay it back in. And it's kind of like it never happened, right?
Yeah, so it's a pretty nice change here. Typically, there's not much ability to get money back into retirement accounts. This is kind of a new way for the government to look at this, actually allowing this repayment over 3 years. So I like to see that, behaviorally, will people repay it? That's a different question, but the option is there, where historically, once you take money out and it's past 60 days, there's no real way to get it back in.
So what about the loan provisions? And I know it applies to 401ks, I believe 403b plans that have loan options, but just kind of explain what that is.
Yeah, so they essentially doubled the 401k, defined contribution, 403b, loan provisions from half of your vested account balance up to $50,000 or 100% up to $100,000. So kind of aligning it with that other distribution exception. That extended loan amount, that 100,000, only applies to, I think the date's September 23rd, as 180 days from the bill. So March 27th and plus 180 days is. So it's a little bit more narrow of a window than the other exception. But remember, with loan provisions, if I took $100,000 out of my 401k, it's not treated as taxable income. There is a essentially 5-year repayment kind of plan that goes along with that, at least quarterly interest and principal payments. There is interest associated with 401k loans. However, that interest goes where? Goes back to your own account. So you actually just put more money in your retirement account. It's not the worst thing in the world when you think about that. So if you're looking at, should I go borrow as a personal loan or even from my mortgage, or should I borrow from my 401k, then put the money back in? The 401k does make a lot of sense, especially if you're a little bit younger and still working.
And I think they gave you a break on the payments for that. Is that what you were talking about at first there? Is that you don't have to make a payment on this particular loan? Normally they start immediately, like the first quarter following, but
yeah, so so this one again is up to the plan provider, but they gave you the option to say really no payments in 2020. Okay. Existing loans that are due or new loans, if any payment was due in 2020, you can essentially push that. That does go down to the plan provider, so the employer level. So it's kind of up to them on whether or not they want to enforce it. Some might, from an administrative standpoint, just roll with what they have, which is still 5 years, but they can push it this year.
Okay, great. Well, those are a couple of good options to be aware of. Now, this third category is feels moldy and boring to me, but it's amazing to me how often we have clients come in and they just have these old life insurance contracts or old fixed annuities, things like that have been sitting around and they don't hardly pay any attention to them. Talk about how those could potentially be a source of cash liquidity in that bucket one.
Yeah, and a lot of those, cash value life insurance is the easier one, meaning that you could pull from the cash value during down market years, essentially, as another option to using cash and to sitting cash on the sidelines. Some of those policies, right, you can actually put some of the money back in depending on how you withdraw, whether it's a loan provision or you're actually, depleting the account. So it depends a little on the contract, but, that is a good option. The other ones you mentioned, there are some fixed annuities out there, or variable with withdrawal riders that have, kind of kicked in at some point. And both of those can function in a similar way in that they can provide short periods of cash flow. I do look at, I've spent more time over the last year looking at the fixed annuity world, really almost actually moving away from bucket one, but into bucket two and creating what I call a bridge of income in there. And so that's something that people have existing policies that work well with that. And it doesn't mean you bought it for that reason, and you might not have bought the life insurance to think about this is going to be a market volatility hedge in retirement, and we're going to use it during down market years. But all of a sudden you have these assets and they work well like that. So again, it's different than saying you should go buy these for these things, but once you have them, can we use them in an effective way? And the answer is often yes.
Yeah, absolutely. And one of the things that is almost never talked about on the life insurance asset class is the unique tax treatment that still is on the books for life insurance cash value. I remember 35 years ago or whatever, when I first came into the business, I I was with a firm that did a good bit of insurance business. So, I kind of learned early on a lot of these rules, but I know you focus a lot on tax implications in retirement planning, and that unique first in, first out treatment available for life insurance cash value. I don't think there's another asset out there anymore that still has that treatment that I can think of off the top of my head. Just explain what that means, just so people kind of know about that.
Yeah, I mean, first in, first out is more thinking you get your basis out first, right? So the non-taxable piece comes out first, as long as it's not a modified endowment contract. So some of those exist, but you would know that. Somebody probably told you that this changed, is now a modified endowment contract. It's kind of a messy part, but yeah, there's the only other thing I would say is likened to it is Roth IRAs have a similar level of tax treatment where your contributions come out, right? Income tax-free first. Life insurance, one of the real saving graces of life insurance at this point has been, I'd say two things. One is the mutual companies have been very strong companies, to be fair. I mean, they've become highly regulated. They have to keep a lot of stuff on the sideline. They've become very conservative companies from the back end portion of the companies. And so there's just been a lot of trust in the policies from well-rated insurance companies that they will be there. I mean, when you look at places like the New York Lifes and some of the other insurance companies out there, they've been around, basically longer than every other company you can name. Lloyd's of London has been around since, I don't know, 1700s or something like that. I mean, these are some of the longest standing companies out there. So they've developed this level of security in their business model from being very conservative. And the other thing is they're actually well organized compared to the investment world, whereas they've protected the kind of two pieces of special tax treatment here, that, death benefits come out tax-free, and that the cash value essentially comes out of your basis, what you put in tax-free too. And those are two really big benefits. And I mean, that's been kind of a saving grace from a planning aspect of life insurance, is they've been able to lobby together, stay together as companies, very secure, very conservative, and protect these tax benefits associated with the policy.
Yeah, and they also allow the policy loans against the deferred earnings on those cash values. The problem with everything, right, is that as the average consumer out there, you don't know what you don't know. And we've come across people in the past who come into our office and we're getting to know each other, and they go, oh, by the way, I've got this little life insurance contract. And we look at it and there's a big loan against it. And, you say, well, we need to take a closer look. And then all of a sudden you realize that if they don't do something, this policy is going to lapse, and then they're going to get a negative surprise in a big taxable event in that situation. So, there's no simple way to do all these things. It's got to always be looked at in the context of an individual's circumstances. And frankly, Jamie, that's what I've always loved about this business. It's what got my attention 35 years ago, was every set of circumstances is unique. And so you mix an understanding of these different tax rules and these different product aspects, and then you take the uniqueness of a family and their circumstances, and all of that can look very different from family to family as to what's the right thing to do. Well, it's amazing how fast these weekly discussions go, Jamie. Again, I want to thank you for showing up with us, and I'll just before we wrap it up here, I'll just tell our clients who logged in today, this, Jamie, is another example of the value of our Carson Group partnership. We have access to incredibly talented, gifted, knowledgeable people on our team, and if you guys have questions, unfortunately, we're not allowed by compliance to have live questions, Jamie, on this format. So we have to ask people to email us questions. But if we get some questions that are above our pay grade, can we follow up with you and get a good answer for a client if they have a question?
Yeah, amazingly, right. We can still answer questions by email, and it's really an archiving issue still with Zoom technology and things like that. But yeah,
okay.
I'd say email you, and you can,
right,
things over to me, and we'll get answers.
Yeah, very good. Well, we'll make sure that we reach out to you if any come through that we think we need your input on. But again, thank you for your help, guys. I guess that'll bring this to an end next week. Zach and I are going to be kicking around in a little depth this weird thing that's been going on with oil prices and kind of how to look at that. We've gotten some questions about, is there an opportunity there? I guess there's always opportunity, right, Jamie?
Yeah, always.
The question is, what's the right way to go about taking advantage of it? Thanks again for being here, Jamie. We're going to go ahead and wrap it up. Everybody have a great week. We'll talk to you next week.